Hello everyone, this is Jordan. This video is being recorded on the late evening of Tuesday, June 18th, 2024. Thank you so much for tuning in. In this video, I'm going to show you two charts that show how gold is scary cheap. Let's get right into the video. Okay, so these two charts are similar. We have this, the gold price to back the monetary base, and then we have the percent backing based on that. These charts will be in my book, which I'm updating. Hope to have it done sometime this summer. It's going to have all of my research. If you like my work, you guys will love this. But that advertisement aside, getting into the charts here. So the black is the gold price, and the blue lines, you have the lower one is 40% backing. The other one is 100% backing. Now, this is based on our gold reserves, our meaning the U.S. So this is based on the U.S. gold reserves multiplied by the gold price, and then that divided by the actual monetary base in the U.S. So this is only U.S. This is not global. So those are the three things that go into this calculation. And so, again, based on the gold reserves and the value of those reserves because of the fluctuating gold price, and then divided by the monetary base, that's how we get this chart. And so here we can see that one interesting thing to me is most of the time, other than right here, aside from this point, up until like really 1990, we were close to 40% backing the entire time. Now, 40% is important because if you go back and look at the 1913 Federal Reserve Act, that mandated that we had to have 40% backing under the gold standard. So that's why 40% is important. And right now, I think the level for 100% backing would be about 22,000. 40% backing would be, I have it in my notes somewhere. I think it's $6,500 or $6,800 an ounce, something like that. But you can see this is a long way to go. And I think this is important here because this is when we started to really spend a lot of money. You had LBJ, Guns and Butter, and all of that. So that started in the 60s, the mid 60s. And that is when the gold price based on this started to get really cheap. And the same thing could be said here in the 90s. Of course, we were in the second half of this brutal secular bear market. Then 2000, based on this, just super cheap. This point here, this is February 2008. You'll see in the next chart, this was actually 30% backing. So it got pretty close here to 40%. But then, of course, all the money printing and spending, the monetary base has exploded. The gold price has not kept up. But you look at this secular bull in gold in real terms, and then this one as well, what happened? The gold price got to a level, it actually went above 100% backing at this peak and this peak. This was a secular bull, and of course it only got up to, again, right here, 30%. But a real secular bull market, another one, and this time, unlike this, we only, remember, this was during stocks in a secular bear, bonds in a secular bull. One reason this was so huge, you had both stocks and bonds in secular bears. We already have bonds in a secular bear. So when we get stocks going into a secular bear in the next year or two or a few years, that's just going to ignite the fire for this thing. But that's enough babbling for me. Let me get into the next chart. So this chart shows, based on the last chart, what percent backing of the monetary base there currently is, based on everything we see in this chart. And what's interesting is, if you look at like here, 1940, it looks like there's points where the gold price, there's more than 100% backing. Here there's more than 100% backing. But if you look here, you can see like this was way more than 100% backing. This peak around 1940, 1980, this was, I think, 130%. I tweeted about this earlier today. So I put in the percent backing. You can see here, this secular low, about 11%. This secular low, 18%. But this low in 2015, an epic low in precious metals, less than 7%. A couple years ago, 7%. But This is turning up. So this is turning up. So that's one thing. Here's the 30% I mentioned, February 2008. But just look at how I don't even have the words to say it. This is just from a historical standpoint. This is mind-boggling when people will look at this in 50 years from now or 30 years from now or 100 years from now. Just how this monetary and fiscal situation is so completely out of whack. I mean, this just, and I say scary because we know that it's more likely than not that at some point in the next 10 to 15 years, you're going to see something like this. It's just the laws of economics and math, as Brent Johnson says. And it just shows you how much higher gold is going to go. Again, we're at, I think, about 10% right now. And what if it goes to 50, 60%? And here's the thing. That's not even factoring in how much more these lines are going to go up. So this could easily go up 5x, 6x, or it would be 4x because it's a 10%, 4x to get up to that 40% level, plus how much more the monetary base is going to grow in the next 10 or 15 years. I know it's a lot of talking for just one or two charts here, but this just, folks, you have to understand from a historical standpoint, and when we're looking at the gold price and its value against things like the stock market, it's really historically cheap. Then you look at it against the monetary base. Holy shit. I mean, this thing is scary cheap. This is why in the next 10 years or so, that gold is easily going to go to $25,000, $30,000 an ounce. It's happening. And it's a little scary to think about it. That's why I say scary cheap. So that's all. It's a lot of talking for just one or 2 points of analysis, but let me know what you think. Thank you so much for tuning in. And if you haven't already, please like the video. I would really appreciate it. And subscribe to the channel. Got a lot of great stuff coming. Thank you so much. And I'll talk to you guys again in the next video.